Hello, and welcome to the FinTech Times podcast, focused on discussing the latest FinTech topics and trends from around the world. Established in 2016, the FinTech Times is a global multimedia news outlet centered around the world's first leading FinTech newspaper. We report all the latest and brightest ideas from the FinTech world.
Hello, everyone. As Mark said, I'm Gina Clark. I'm the editor-in-chief of the FinTech Times. And welcome to our panel, What Will Digital Banking and Lending Look Like in 2022? Not so far away now. As customer interactions move predominantly online, access to digital software has never been as important. Now that significant final transactions alongside regulatory practices, such as KYCs, rely on technological improvements, banks and other financial establishments need to undertake considerable burdens to make sure that information is accurate, customer relationships are protected, and documents and processed with speed and efficiency. To that aid, I'd like to welcome on screen our panel today, Stanley Chow, Senior Marketing Manager at Foxit Software, Brian McKenney, Chief Innovation Officer at HSBC, and Ron Shevlin, Director of Research at Cornerstone Advisors and Senior Contributor at Forbes. Welcome, everyone.
Thanks, Gina.
Nice to have you. I think to start, it would just be good to get a bit of an understanding of the impact of the pandemic and perhaps what have those key changes been when it comes to digital banking and lending since the pandemic began. Stanley, do you want to kick us off?
Nothing spurs major change until something catastrophic happens, right? Even before the pandemic, the digital banking initiative was on the rise, but more so at a leisurely pace. There was no true urgency to push it forward, even though this was clearly the next logical evolution of banking. But after all the lockdowns from the pandemic, digital banking became an absolute must-have, and really it couldn't have come soon enough. The need for digitizing financial services was always there, but since the pandemic forced the hands of managers, the pace to do so has accelerated that to warp speed. And also managers have changed their views on the importance of digital banking, as it's now viewed as a crucial way to build a sustainable operating model to meet evolving customer preferences, as well as to support an environment where employees can work remotely. And now that the benefits of digital banking, speed, convenience, easy access, to name a few, now that they've been realized, there's really no going back, even after the pandemic is under control. And so a high volume of bank transactions will continue to take place through online and mobile channels. And customers are going to expect not only your services to be available online or through mobile, but that it can also be completed on that one single channel. And what I mean by that is if customers can start a process online, but need to complete it elsewhere, say signing papers at a local branch, that's going to cause frustration and abandonment, and possibly a switch to a competitor who can provide these services more easily. So while the pandemic has elevated banking and lending services to digital levels we've never seen before, it's also challenged financial institutions to step their game up and see how they can streamline processes that are still causing friction. Can your customers now complete transactions in a 5-minute phone session on their phones? Can they digitally share identifying documents, or do they need to physically prove their identity or sign paperwork at your local branch? And so these are the kind of issues banks need to tackle moving into the new year as digital banking becomes more and more prominent.
Absolutely. I think customer interaction, and we're going to come onto that soon, is a real key. I myself have changed banks through frustration this pandemic. Ron, what are your key thoughts on that?
Well, I think Stanley said a lot there, and I totally agree with everything. There's not necessarily a whole lot to add, but I'll try to give a few different perspectives here in terms of the impact of the pandemic. I think, first of all, I think there's been a misconception and a common sort of misunderstanding of the impact of the pandemic. Many people have talked about how it has accelerated digital transformation in the industry, and I dispute that. I think, as Stanley points out correctly, it has certainly accelerated digital adoption among consumers, but I don't think it's necessarily accelerated digital transformation among the institutions themselves. I think there are still plenty of financial institutions that are way behind the game in terms of digital account opening. But even beyond that, just a lot of regular everyday type of processes that have yet to be digitized, or better yet, think of them as sort of having good digital support. And I'll give you some examples of this. I did a consumer study of US consumers in the middle of this year, asking about their channel usage, not generically, but very specifically looking at interactions like disputing fees or reacting to potential fraudulent activity. And I wanted to understand, how were consumers getting these done and what channels were they doing? And what I think many consumers have found is that they've actually start the process of disputing a fee or resolving a fraudulent fraudulent activity online or through some digital channel, only to find that they can't do it. The support isn't there, and so they have to turn to either the branch or the call center. And so what's interesting is that coming out of the pandemic, not only has there been a huge increase in digital adoption, but there's actually been an increase across all interaction channels. More consumers are calling in, going to the branch. What happened was that the pandemic changed and impacted people's financial lives, causing them to need more support and interaction and involvement from their financial institutions. And listen, here's the thing I always argue with bankers about, and there's no shortage of studies that ask consumers about their channel preferences. People don't have channel preferences. They just want to get what they have to do, get it done in the easiest and most convenient way possible. And so this idea that consumers have a preference to the digital channels or the branch channel or a call center is wrong. They just want to get done what they want to get done. And so I think taking channels out of the equation is something that I think the smarter financial institutions are beginning to understand, is they have a process that has to get completed. And there are many different ways for that process to be completed, and figuring out how to get it done most effectively is the challenge that many financial institutions have now coming out of the pandemic.
Excellent, thank you. And Brian, HSBC, a global bank facing a global issue of the pandemic. What were your key changes in digital banking and lending?
Yeah, I think that Ron had made some very good points in terms of the customer experience improvements that are still needed across the industry. I would counter that. I think speaking from our perspective, there has been massive changes in our digitization, and I think across the board in many institutions, of those customer journeys. So, first and foremost, the immediate reaction was a surge in digital transactions, especially those from the apps that we have. We saw triple-digit increases, from when the pandemic took, in terms of, and this I'm speaking from a commercial perspective, so business customers, which is where my primary focus is. So all of a sudden there was a lot of transactional activity that was moving digitally as soon as the pandemic hit. That's sort of as one would expect. But what we've been able to do since is enable digital onboarding and digital credit applications, in particular in response to the government schemes like the bounce back loans in the UK and the PPP in the US, such that thousands of businesses could apply for not just a bank account, but actually the credit that was coming through those schemes, and have that experience be fully digital. The means of enabling that, and I think this is quite critical for any institution in this space, is cloud. We had fortunately been making a big push into cloud, and when the pandemic hit, it was a real sort of double down moment, recognizing and realizing that for those platforms that have been built cloud native, there is a much quicker ability to get not just new features to customers, but to have those features be more digitized. There's still room to go on the end to end. I think Ron's point on some of the customer journeys where there's issues and queries, you do find that there's still room for a more digital experience in a lot of those. I do think that the journey is well underway, and I think cloud's a critical part of making that happen.
That's interesting. And I think, we've spoken a lot already about the customer journey and the pain points that we've all faced since the pandemic. But do you think there's been a certain demographic or a location that's faced these problems more than others? What's been the customer reaction to the move to online? Stanley, do you want to kick us off on that one?
As I mentioned, how going digital, was a long overdue initiative, and as Ron and Brian said, we've got ways to go. Well, the reception so far has been mostly positive, I'd say, especially for those who prefer to get things done online or through their phone. And that's really not a big surprise, considering how many of our shopping habits have already migrated from in-person shopping to online. So it makes perfect sense for banking to shift their services to online channels. And the switch from physical branch visits to digital banking was a welcome change, especially for young customers who enjoy the convenience of bank access right on their mobile phones. And for older customers wanting to avoid the risk of contracting COVID, it's just a necessity now. And then there are pockets of those, likely the oldest cohorts who will likely return back to physical branches when it's fully safe to do so, simply because they want a human connection or a touch to guide them through certain services. And so no matter what, we saw a widespread shift towards digital banking in a matter of months, really, which otherwise probably wouldn't have fully played out for another 2 to 3 years under more normal circumstances.
Excellent. And Ron, you talked about, a frustration from customers. They just want to be able to talk to their banks. Do you think the move to online is in these sort of pockets, in these demographics, in these locations, is that here to stay, or will we figure out something else?
Well, I think we don't ever go backwards in this industry. We just move forward, and the problems accumulate, and the channels accumulate, and so forth. I think to answer your question, I'm not sure that there's a lot of geographic differences that play, but yeah, across the demographics, I'm not sure one has any more challenge than the other, but there definitely are differences. One thing that surprised me in some of the research I did this year was I asked consumers about their use of account managers at their primary banks. And I was actually pretty surprised to find out that a larger percentage of Gen Zers and millennials have account managers at their financial institutions. And if they don't have one, want one, then baby boomers. And I'm a baby boomer, and I don't even use an account manager anymore, because all they ever did was try to sell me things. But I actually was surprised to find a relatively higher percentage of Gen Zers and millennials who wanted account managers, use their account managers, and use them to talk about their financial health, their financial lives. What products do they need? And so, yes, we've seen this huge adoption, especially among younger consumers, of digital tools, but they're also turning to humans. And I think this places a huge challenge on a lot of banks to be able to meet those needs. I immediately thought, it was like, how many consumers are going to their personal financial management tools online and getting the same advice and guidance that they would get when they call in and talk to a human? And I would guess the percentage is pretty low. So you get those challenges for the Gen Zers and the millennials around that channel coordination aspect. Turn the attention to the Gen Xers, and these are a group of folks, believe it or not, who at the older end of the range are in their mid-50s already, late 50s. They're starting to think about retirement. Their lifestyle changes have really evolved. They're, hate to say it to you, Gen Xers, you're not as young as you thought you were, but they're getting on there. And then from the baby boomer aspect, our adoption of mobile banking tools just exploded. On top of that, I just want to relate to something that Brian mentioned as well, which is the whole challenge around small business. And because of the pandemic and the economic impact, their banking needs in general were impacted greatly. And I think that there's been a couple of trends that have played in, and it's going to have a really big impact in 2022. One is the PPP loan program here in the US definitely helped a lot of financial institutions either establish or reestablish their relationship with many small businesses. But I think many banks are ignoring just the huge threat of companies like Shopify, Amazon, and Square, or now called Block, I guess, after yesterday. That'll take me a while to get used to. Who are really fundamentally approaching small business relationships from a very different perspective. Many of them come into the small business relationship either through payments or through sales and marketing, and then expand to banking and lending services, and can do so because they have so much information about the small businesses. And I think one of the big changes that we'll see in 2022 from a mobile banking or digital banking perspective, from a small business perspective, is more proactive use of data around small businesses to help them with their lending needs. And Brian, maybe, with his focus on commercial, can either expand on that, or if you feel, Brian, like I'm on the wrong path on that one, feel free to disagree.
Hop in, Brian. What have you got to say?
Perfect. I think, Ron, you're spot on. And I think that one of the key developments that's taking place in the landscape is this notion of embedded finance or banking as a service, whereby there are certain technology platforms and products that people and businesses use. From a business perspective, they're increasingly important to running and growing their business. And it's almost becomes their sort of day-to-day operating system. And it is a logical and valuable, from a customer experience perspective, place to embed financial services. So companies like that you've named, we, for instance, announced a partnership with Oracle NetSuite, the ERP provider, to do this. And I think it's going to be an increasing trend and a really powerful way to meet small business needs, bringing banking services into the products and platforms that they use on a day-to-day basis to run and grow their business.
Excellent. Thanks, Brian. And picking Ron up on my not so younger joke earlier on, the other day I had to help my 86-year-old grandmother use a £100 contactless limit for the first time. She was overjoyed that she didn't need to touch any buttons anymore. She could just tap it on the screen. So I understand completely how maybe the pandemic is opening up opportunities, as well as obviously we've had a lot of banks and branches closed during the pandemic. And that's frustrating both for the consumer and for the small business as well. But great insight. Thank you both for that. And one thing we haven't touched upon is, I guess, the rise of the neobanks. We've talked about kind of tech integration and fintech, but how are we going to keep these banks staving off the neobanks? What do you think, Stanley?
So for the last 20 years or so, we've seen a boom in technological disruptions in industries across the board, and for the most part, banks have been able to hold on to its dominant position because of the heavily regulated environment that it's working in. But what we're starting to see now is that this landscape is quickly changing, with fintechs leveraging technology to close the gaps, and banks can't afford to fall behind these more agile companies that tout a digital first, more customer-centric experience. Customers today have more choices than ever before, and if they don't like one company's service, they can just jump to another. And neobanks are looking more and more like attractive alternatives that could meet their demands for faster service. And so to keep up with these new challengers, banks should be fully embracing digitization efforts inside and out. Doing so not only drives down your costs so that you can offer better rates, but it also speeds up your operational efficiency, which cuts down turnaround times and improves customer satisfaction. And the best place I'd say to start is really with overhauling manual processes that can be quickly addressed. There are still banks that have this hybrid model where customers they're opening a new account online, but they still need to come into a branch or mail in signed paper documents before that account can actually be activated. And so anytime paper is involved, transactions can take a few weeks to complete, or longer if errors are discovered. And these basic processes these basic processes that are frustrating customers expecting quick turnaround times, and they should be streamlined right away. For customers who are used to speedy services of online retailers like Amazon, as Ron mentioned, the same is expected of banking services. So opening an account should be able to be done in one online or mobile session, and less fragmented. And so digitizing the entire account opening experience end to end is a surefire way to satisfy customer preferences and minimize abandonment rates. And that, I think, will put you in a better position against neobanks.
Excellent. Ron, would you agree?
I would agree, but I'd like to add a couple of perspectives as well. First, I want to start with a quick story. I was doing a board presentation at a mid-sized financial institution a number of months ago, and I asked them, to what extent do you see impact on your customer member base of the neobanks? And they said, we don't see them in our market. I'm like, of course you don't see them in your market, because they don't have a physical presence. And I think many banks are overlooking the threat of these neobanks. And it's funny, in the US, at least legally, we're really can't call them banks. And I've tried to call them community fintechs. And the reason I call them community fintechs is that when you really look at the ones that have been successful or are gaining some traction in the market, at least, because bankers will argue that success is about profitability, and many of these challengers aren't necessarily profitable just yet, but they're certainly gaining customers. And many of them that are doing so are taking a very affinity or narrow-based segmentation approach. So companies like Aspiration that focus on consumers who are environmentally conscious. Daylight focusing on LGBTQ consumers. There's a challenger bank called Panacea Financial that focuses on the needs of young physicians, not just all physicians, but young physicians who are just getting out of school, getting out of their residency, have very unique needs. And the common thread among many of these neobanks, challenger banks, community fintechs, whatever you want to call them, is that they've identified the unique financial needs of a particular segment of consumers. And so to the banks and credit unions, the traditional ones that I talk to that don't see the impact of these companies in their market, it's because none of them are big enough to really challenge them head on. They're chipping away at their customer base and pulling them away. So I totally agree with Stanley about a lot of the efficiency issues and customer experience. But I think there's a much more fundamental strategic decision that many small, mid-sized institutions have to make around who their target market is. And some will be able to do so at a very large national basis. You look at a Navy Federal Credit Union or a USAA that serves the needs of military members. Well, they're geographically dispersed in quite a large market. But for others like teachers, credit unions, or maybe some other specific niches, you're going to have to sort of get past the geographic limitations that they have in their market today and really start to understand the niche that they serve. Give you a good example. I was talking recently with the Los Angeles Police Federal Credit Union that serves law enforcement professionals, and they understand and know the needs of that segment of the market better than anybody else, and need to take that set of capabilities nationally, or at least through partnerships and other ways of doing that. And give you proof for this. I mean, look at the European neobanks that have come into the US, like Monzo and now N26, which has announced that it's closing, because they didn't come in with a unique focus or a narrow niche and just thought that, hey, we're a better digital bank. Guess what? It doesn't matter that you're a better digital bank. People don't want better digital experience. They want a better bank. They want better products and services. And I think this is the key to staving off the challenge of these community fintechs, is understanding your niche and who you serve.
Great time to bring in Brian.
I feel like the I feel like the bank spokesman over here,
ganging up on you. Do you think there's room for all in the market, or is it sort of more tailored products and services that banks need to look at, or is it just a innovation digitally? What do you think?
I think each institution needs a clear strategy, a clear customer focus, I think the points that Ron made on neobanks was very well made. There has been a real uplift in the bar of what banking needs to be, and evidenced in the customer numbers of many of these organizations. And so, to the points that Stanley made, I think that the digitization of the experiences is a must. Broken customer journeys are really no longer suitable in the 2020s. So that's a table stakes, I would say. And then it's how can you lift the bar in terms of your customer product fit. What's the real value that you're bringing? We designed and launched a new product called HSBC Global Wallet, which is a multi-currency digital wallet focused on businesses that trade internationally. So we have a sweet spot that we're focused on. And I think in each institution, finding that target market and what's that killer product or use case that will bring them real value is really the foundation of a strategy and how you go to market in today's age.
Excellent. And I have to say, I'm looking at the chat. We've got some great questions coming in. So maybe we could rattle through the last 1 or 2 of ours, and then we can dive into the chat if that works. Let's just talk quickly about 5G, because I think it seems to have dominated the news and then dropped down recently in the last couple of months. So, 80% of the US is now under 5G coverage. So how important is it that traditional financial elements are available on the go? Stanley, you mentioned earlier about mobile bank account opening. How important is that now that we have infrastructure able to support it?
Yeah, so I think so much of the focus has been, improving front end consumer-facing interfaces, which is great, but it really is like putting a Band-Aid on a gashing wound and not really addressing the root cause. And banks should in parallel examine their back-end operations to identify any gaps in efficiency. If there are workflows behind the scenes that require human involvement, it's only a matter of time before errors occur and back up the entire process. I'd say in the case of handling certain services online, like such as loans, which require tons of paperwork verification, adopting technology that automatically routes documents from department to department for review and approvals speeds things along and minimizes the chances of errors being made. In fact, this is almost table stakes. Now that companies are adopting a more distributed workforce and employees are they aren't in the same building anymore because of the pandemic. And so simply maintaining the status quo of inefficient legacy background infrastructures, that's going to fail to support the speed of these on-the-go services demanded by customers. And so prioritizing forward-looking technologies that de-emphasize manual work in favor of automation, that's going to go a long way towards enabling those on-the-go services to be more responsive and seamless.
And Ron, when it comes to kind of capturing those little pots, those different targets, what do you think what questions should consumers and small businesses be asking when it comes to deciding on their financial institution? What should be in their head? What's the questions to ask?
The questions they need to ask is first need to ask themselves, what do they really need? What are their specific product and service needs that they need? Because if they're just going to walk into a bank branch, if they're just going to go to a bank website or contact somebody at the contact center, if they're not able to elaborate on what they're looking for, what their needs are, they're going to get very generic kind of things. And this is why I think banks can't rely on survey data for these kinds of things, because when you ask consumers, well, what's most important to your choice, it's still amazing how many say location of bank branches, which is really hard to kind of believe in today's day and age. But it really has to start with understanding their own needs and then being able to test that premise with various financial institutions to say, it's great that you've got a well-designed, slick mobile banking app, but how are you able to meet my need to do X? How are you able to meet my need to do Y and Z? And if you're not, as a consumer or small business or even corporation, able to elaborate on those needs, you're not going to be making an optimal choice of financial institution.
Thank you. And Brian, last question just before we go over to the chat. Bringing up the millennial question, who seem to be fast becoming the most sort of important demographic right now. How can banks attract or retain millennials?
Well, I think obviously the digital experience needs to be, on the level of what they experience in their day-to-day life. It's a very high bar, but it's important to recognize that's what's expected. Finding that ability to bring some sort of social engagement into the product is a really beneficial way. How Ron spoke around the targeting of communities. Something we did called Pay Me in Hong Kong was a social payments app where, paying back friends and family, like we've seen with apps like Venmo, those are really good ways to get engagement. I was part of that, and we were so surprised to see that people communicated with emojis. There was a whole debate whether we should even allow customers to use emojis when they would send payments to each other in the payment message. And the team creating the app won the debate, and we put in emojis, and they were extensively used. And so, little things that sort of resonate from an experience standpoint, in addition to having that rich digital offering, I think are really valuable within that segment. And then there's always a real need to just have a good customer product price fit. To Ron's point, do you have the products that the customers need, and are you offering them at an attractive price that creates value for those customers? So taken together, it's a combination of these things that I believe create the winning formula.
Excellent. And maybe just going back to Ron on that question, what do you think about the millennial issue?
Actually, Gene, I want to touch on your use of the term retention. And I think retention has become an outdated concept in banking. Reality among millennials in particular, and increasingly among Gen Zers, is that they don't switch relationships. They basically just add relationships and change their behavior and their activity. I see too many banks and credit unions bragging that their attrition numbers are in the mid-single digits. Right. Because nobody's closing out accounts anymore. That's too difficult to do, or not worthwhile doing. They just move their money and shift their behavior. And the other reason that retention becomes this outdated concept is because it's really more about both share of wallet and share of activity, maybe more of a mind share type of thing. I have been pushing this concept the past couple of months that I like to call consumers' shadow financial lives. And when we think of the shadow economy, we think of illegal and illicit things. And I don't mean to conjure up notions of illegal behavior among consumers, but more that it's shadow and that it's behind the scenes, unrecorded, not visible to the bank's naked eyes. And it's not untypical or atypical for a millennial or even Gen Z couple to have 30 or 40 different financial relationships. And these are not all accounts, but they're relationships. People are using Dave to help them manage their checking accounts. They're using Credit Karma to manage their credit scores. They have an investment account with Merrill Lynch, but they've also got one with Robinhood and are using Investor to play fantasy finance and have Coinbase to trade their cryptocurrency. It's not unusual to have 30 to 40 different relationships now. And so the idea that, we're going to retain our customers, or dealt with a management team recently who was struggling and wrestling with, how do we get more of our customers to move their accounts to us? You don't. It's not how millennials and increasingly Gen Zers manage their financial lives. So this whole notion of retention, I think, is becoming an outdated term, and certainly an outdated metric to measure your business on.
I think that's a really excellent point, Ron. I mean, to me, monthly active users and really weekly active is a much more important metric than number of customers. What's your engagement? How regularly are they using your services? Because that's where you can get a real pulse on the level of activity that those customers have, not just the raw customer numbers, because I think what you've articulated there is absolutely taking place.
Yeah, and the thing I'd add too is how it changes for 2022 is that mobile banking is going to expand beyond just banking. There'll be more services like data breach protection, identity theft protection, subscription management, other services that get bundled into the mobile banking application, cell phone damage protection. These are the kinds of things. The mobile banking experience needs to become more supportive of how consumers manage their financial lives, not simply about banking. And I think that's one of the changes that we're really going to see start to explode and increase in 2022.
It's going to be interesting when we come to the end of 2022, looking back and seeing how much of this has actually been kind of taken and implemented and we're kind of running with now. But over in the chat, it's all kind of about practicalities. If you want to take a question, just shout, put your hand up and I'll come to you. But first of all, why does it seem so difficult for US banks in particular to implement something as simple as an electronic signature rather than a paper form? This is something you were shouting about, wasn't it, Stanley? What is the difficulty that we're finding here?
Yeah, I mean, you would think something as, the way we do everything, so, digitally now, you would think, electronic signatures is it's like a no-duh technology to use. But, in reality, I would say, first of all, before the pandemic, there was this, this mysteriousness about electronic signatures and its legality. But when in fact it's been legally recognized for over 20 years because of the e-Sign Act and UEDA. But I don't know, for whatever reason it hasn't caught on. I would say in the case of financial institutions, compliance plays a big role in the matter, and then also just seeing the ROI. How much time. I think IT managers need to see, how much ROI they're getting from implementing this technology. And so I also want to say, banks being the tradition, kind of being this conservative traditional institution, inherently, change is a big deterrent, I would say, for adopting something that can radically change your entire systems. With the electronic signatures, you can, accept more applications, more loans. You can take in a lot more business. For them, I think that for banks, I think that they need to realize that there are some longstanding benefits to e-signatures besides the initial investment.
Excellent. And something, Ron, that you picked up on earlier, face-to-face versus digital services. How are we prioritizing them? Should we prioritize one over the other?
I'm sighing because I have hit my head against the brick wall around this for about a year, maybe 2 years now, and I'll try to get it across here as well. The branch is not important. It is simply not important. What is important is human interaction. And in 2021 and going into 2022, look at what we're doing here. We are all interacting human to human, but we're not in the same room, same location. There is technology to facilitate human to human interaction. And so I blanch at the use of the term face-to-face services, unless you want to call this face-to-face. That's why I say take channel out of the equation. The challenge is, how do you get stuff done in a way that gets it done efficiently and in a way that makes it easy for everybody involved to get it done? And the reality is that through Zoom, through FaceTime, through online chat, digital chat, other texting capabilities, there are ways for humans to interact more efficiently today than forcing somebody to get up, get in a car, and drive down to some physical location to interact with somebody. And you could argue that, well, the telephone enabled that, but we have so bastardized the capabilities of the telephone with the phone trees and authentication procedures, it's become an inferior channel. So it's not about prioritizing digital versus face-to-face. It's prioritizing services and processes that need to get fixed and improved, that fit with the needs of your market and how you are, as an institution, competing in the marketplace. Get the damn channels out of the question and the challenge. That does not matter.
And that kind of nicely leads me on to this. I think it's probably going to be our final question now, Brian. But, that back end that we keep hearing, legacy systems and everything else. The question is, are banks really digitizing? It seems like little is changing in the operational and back end services, and more focus is on user experience and digital shop fronts. Why is this? Or why is it? And also, do you agree, I suppose?
I think it's a fair question. And I think certainly, in terms of why, the back end's a lot harder to fix, right? A lot of financial institutions, you're talking about mainframe systems that are 30, 40 years old. And they're hardwired and have been running the bank, really since the advent of technology being implemented at institutions. And it's, quote, easier to get the front end, the digital UI, let's say. But in my view, and increasingly the how we approach digital is it must be end to end. So just because the experience on the channel, and I think Ron's articulations here are so spot on, right? It's got to be an end to end journey that doesn't require human intervention, and then when human intervention is required, that experience can take place quickly and have a quick resolution. The edge cases that are there for a lot of products, those have to be addressed in the very initial product design. It must be done end to end. And then, this is where, in my experience working with cloud and bringing that, to the forefront of how we build new products, is those are really important technologies. So it's actually moving away certain functionalities from those legacy mainframe systems into the cloud, partnering with third parties that have really great capability that can be real accelerators. It's a massive effort. It requires a real commitment of the institution from the top, creating the right teams, the right culture to tackle these issues. It is paramount to the success of financial institutions, and their ability to meet customer needs in this age.
Excellent. Well, I think we're almost time to wrap up, but maybe one quick sentence from everyone. What would be the key change that you'd like to see in banking and lending in 2022? Stanley, have you thought about that at all? Oh, you're on mute.
Unmute myself. Yeah. So, I'm a little bit biased here, but obviously I'd like to see more massive adoption with technologies that can streamline, bank processes in the front end and in the back. I think, as I said, electronic signatures goes a long way towards making that happen. It eliminates all the paperwork and actually just automates every process so that services can be accessed fast. Turnaround times can happen faster for customers and make bank employees more productive as they're spending less time on paperwork and doing administrative tasks.
Great, thank you. Ron, what would be your change?
4 words: better use of data.
Like it, nice and short. And Brian, what would be yours?
Embrace disruption and level up. And whether that's new technology, cloud, fintech partnerships, or entirely new business models, going to where customers are rather than assuming they're going to come to you. So it's embrace disruption.
Brilliant. Well, thank you so much, everybody, for a great panel today. I found it so fascinating, and I'll be sure to go and catch the recording later on as well. So thank you for joining me. Remember, if you'd like to continue the conversation, we are on Twitter, #FinTechTimes, Future of Digital Banking, and @the FinTech Times if you'd like to follow us. So thanks again, everybody, and have a lovely rest of your day, wherever that may be.
Thanks, Gina.
Thank you.
Thank
Bye.
you.
Thank you for listening to the FinTech Times podcast. We hope you enjoyed the discussion as much as we did. Don't forget to check us out at thefintechtimes.com and subscribe to our monthly publication to keep up to date with all the latest FinTech news.